And now we have our first panel of the day here on the Builder stage, which is what you need to raise a Series A. So this will help founders who are building at the seed stage prepare for their first lettered round. And we have a great group of investors today who will explain what they're looking for and what their firms are looking for their next Series A investment. So please welcome to the stage, we have Renata Quintini, who's the co-founder and managing director of Renegade Partners. We'll have Corinne Riley, who's a partner at Greylock, and Elizabeth Yin, who's the co-founder and general partner at Hustle Fund. So please give them a warm welcome, and I'll see you soon.
Hello, everyone. Welcome to Disrupt. So everyone knows that funding was frenzied in 2021, 2020, and then died off in 2022, and by 2023, some 3,200 startups had died. It wasn't good. In 2024, it was all about AI. Like, everything had to be AI. So my question, Renata, for you is, what will funding look like in 2025?
All right. Hi, good morning, everyone. Great to be here. I think it will continue to be a tale of two cities, with some companies really having the promise of going after big markets, growing fast, receiving a lot of funding and momentum, and then on the other side, other companies that need to build real businesses and efficient businesses. I don't think it's going to be very different than 2024 for the ones that are getting started. I think it will be different for the later stage stuff. It will be more of a crucible.
And so do you have to have AI in your pitch deck or forget it?
I think every company will become an AI company. It's only a matter of time. So yes and no.
All right. Corinne, what sort of milestones, especially in 2025, should early stage startups expect to hit if they're even going to expect to consider a Series A?
Yeah, it's a great question. It's a question that we get all the time from founders. So the caveat I'll give it, every answer I'm going to give is about enterprise, because I primarily focus on B2B. So I would say that the question we get is, what ARR do I need to hit to get to a Series A? And from our perspective, there is no set milestone. There is no key number that if you achieve it, you're going to raise a successful Series A. What we're looking for is actually the quality of the ARR and not the quantity of ARR. And what I mean by that is we're looking for a customer base that, even if it's smaller than your competitor that has a higher top line number, is repeatable, is in the right ICP of what you're looking for, and is something that once you add fuel to that fire, you're going to be able to grow it much more. So I would say the answer to the question isn't there's a set number that we're looking for a Series A, but we're looking for a quality customer base that you're going to be able to repeat over and over and over again once you have more capital.
So Elizabeth, how helpful is it when raising a Series A that a startup has gone through an accelerator, particularly Y Combinator, but there might be others?
I think that VCs in general don't really care at the end of the day, but if you do go through an accelerator, are you making the most of it? So for example, actually, I think, beyond trying to bump up your valuation by going through YC, companies that really benefit are ones that could, utilize the alumni base, for example. Can you get customers from the alumni base? I've had portfolio companies who raised a pre-seed and sometimes even a seed and then gone through YC because they felt like it could be really good to be able to get in front of this network. And so that's how I would think about an accelerator. What is it you're getting from the accelerator? Can your company maximize that to be able to get to this next level?
So Corinne, you had mentioned that it's quality of their AIR instead of some kind of number. Can you walk us through some kind of an example from your memory of someone who got a great Series A and didn't have the highest ARR?
Yeah. I'll give an example of a company in our portfolio. We led in a seed in a company called Brain Trust. This company is an AI infrastructure company. It allows companies to evaluate LLMs in production. And we led the seed last year, and at that point in time, I would say there were probably 30 to 40 additional competitors in the market. We met a lot of them. And what really stood out to us in this company was the founder, Ankur. He had a very strong point of view of what LLM evaluation should look like. And more importantly, he was working with tastemakers in the industry. He was working with companies like Coda, Notion, Zapier, people that were at the forefront of building products with AI. And that was at the seed. Braintrust has now raised a Series A, where we double down, and A16Z has also led an investment in the company. And what happened between the seed and the A, they could have easily gotten, an outsized number of ARR if they'd gone out to enterprises and anyone they wanted to go to. But what they continued to do is they continued working with the tastemaker builders, right? They work with Stripe, they work with Notion now, they work with Replit, they work with the browser-based company, with companies that are really at the forefront of AI. And so now they have this base of customers that is, in my opinion, what everyone wants to aspire to when they're working with AI. And so instead of going after companies that they could have easily gotten a very large ACV from, but realistically didn't really know what to do with the product, they went after the people that mattered the most. And in my opinion, having that focus on the best customer base, it's what's allowed Braintrust to become the #1 company in the space.
Okay, interesting.
Can I jump in?
Yes, please.
Because I think, this is a really great point, because I think in the end of the day, what you're trying to do is, one, build something that compounds, and then number two, you're either going to be in a business that you run faster than the other people, or you do something that other people cannot replicate. And when you kind of lock in this partnership base or this customer base that is really unique and one of a kind, revenue can't buy that. So this becomes an advantage that you have that other people cannot replicate. And that creates space for you to continue to execute and do things that other people cannot. And that's
And this is
super
what
valuable.
VCs mean when they talk
Yes.
about, you need to build moats. Like obviously, there's only so much you can do. People can always compete with you, but the more unique things that you can do that other people can't do, the more that helps you, and that customer lock-in is certainly one of them.
Yep.
So Elizabeth, when it comes to valuations, is bigger always better?
Well, I think we've all kind of seen the negative impact of having a valuation too high from the last, let's call it 3 years. In 2021, a number of companies were able to raise a lot of money, but didn't necessarily have a lot of traction. And so now, 2 or 3 years later, the bar is higher for that next round. And it is still actually really hard for people to either grow into that last valuation or even kind of stay at that same level. And so that's something that we're now seeing the repercussions of. And so, no. I mean, I guess if I were to put a sort of a rule on it, and like everything else, there's no rule, when you think about your valuation, is it sort of maybe double what your last valuation was, or maybe triple, depending on how fast you're growing. But it shouldn't be anything really crazy that you don't think you can grow into realistically with your traction.
Because it always catches up with you. Right? So I've been in this business for 17 years now, and it used to be that raising capital was a competitive advantage. I raise a big round, I have more capital than other people, so I can hire engineers other people can't, or I can do something other people can't. That advantage is gone. So it's really about execution, and evaluation is what you think your company is going to be worth in the future that you kind of bring to today. And you can't run away from it. At some point, you need to build a business that actually earns that type of price. And let's not forget the impact it can have on 409As, right? Because you give equity incentives to your employees based on the valuation you have. And if that gap doesn't close, you're actually disincentivizing the people that joined you early on, et cetera. So there are a lot of implications about getting the valuation right.
100%. And the other thing is, if you end up getting stuck because your valuation is too high, if I were to just spell out the repercussions, a lot of VCs just won't even look at those companies because it's just too complicated to try to either restructure or deal with, and that makes that fundraise that much harder than it normally would have been.
Yeah.
So Corinne, should they have a valuation in mind before they go out for a Series A, so that if they wind up getting bidded up or their heads are swayed by someone with a fancy term sheet, They know to stand pat.
Yeah, I mean, my advice for everyone when raising any round, right, and this starts being true at the Series A, but it's true for rounds subsequent as well, you want to go into the process, you want to create a tight process, right, and you don't want to be dilly-dallying and have a multi-month, round. You're wasting your own time, you're wasting the VC's time. So you want to go in and you want to know exactly how much you want to raise. That is the first key number to know, and that is the number that you're going to be telling VCs. Now from then on, you have two choices. One, you can set expectations for what the valuation is, or two, you can say, I'm going to let the market decide. And I would say, candidly, we see it both ways. And our perspective is it's your company, you can do what you want to do. And if you want to go for an auction and just see what everyone is going to bid, you can do that. Or we've successfully seen and participated in rounds where the founder will set a very clear expectation of what they want the valuation to be. And hopefully they meet that.
But I think on the setting the valuation thing, right, the market has a little bit of a band of dilution, and you can see, reports, call it 20-25 seems to be an acceptable average band. Some companies go for way less dilution than that. Some companies may go for higher dilution than that, depending on the quality and also the market. But if a founder kind of comes and sets the price as, I want 10% dilution, so you're kind of way off an average expectation, you better have a fantastic business and be an outlier company to back it up. Otherwise, you're actually going to be turning VCs off, in my opinion, if you kind of come in with that sticker price that is too much of an outlier.
Yeah, and this is where I would actually be more in information gathering mode first before you anchor yourself in evaluation. Right. Some firms are okay with 10% ownership. Other firms want the more traditional 20% plus. Right. So knowing who you're talking with is really important in that conversation. And so if you're not quite sure, I would be in research gathering mode before you say, oh, this is the valuation we're looking for.
And I mean, we've seen there was a company that raised in 2021, super hot market. The product was so exciting that the day the A closed, somebody else came and gave a markup to that round. So the experience of the founder, oh wow, fundraising is easy. This just kind of goes like that. And then when 2022, 2023 came and the market reset, the founder's experience hadn't reset. And that founder came to market hot saying, I want a certain price, but the market wasn't there anymore and wasn't able to pull a fundraising like that. So it was spoiled by 2021 and thought it was easy and expensive. So what Elizabeth said about info gathering is super valuable.
And I think it might also be good to touch upon what creates these markets going up and down? And really, I think, when I was a founder, I had literally no idea. But what is happening is the money, you need to think about the money across the whole stack. Founders raise money from, let's say, VCs. VCs raise money from their investors, fund of funds, institutionals, et cetera. And some of those even raise money from others themselves. So there's a whole stack of fundraising happening that you don't see the whole stack of. But when the folks who are funding you are having trouble raising money themselves, then that means there is less money to go around, right? And so it's totally a supply and demand problem. There is less supply of capital for the same number of startups, and that's what makes the bar go up, that's what makes valuations go down, and all of this stuff. So, I would just call it out that right now VCs are also struggling to raise, or it's slower to raise, just like for founders, and it's all throughout the stack. So that is what's happening, and that's why these market dynamics happen. In 2021, it was the opposite.
So Elizabeth, have you ever seen a really terrible seed term sheet? And have any of you guys ever helped a founder unwind a not so great early seed situation to get them to the Series A?
I've definitely seen a number of my founders, especially international companies, get all kinds of term sheets with all kinds of terms that I would consider non-standard. And then just to throw out a few of them, it could be, weird board configurations. It's like five investors from the same firm on a board with the founder. That basically means you're going to get fired. All kinds of liquidation preferences that probably haven't been seen since the 90s, like where investors get some huge multiple before everyone else gets paid, things like that. We usually try to get involved with our startups in being a sounding board on these things to prevent that from happening, and I've encouraged our founders to turn the very non-standard things down, and then there are some others that are borderline, and maybe you take it because you don't have any other options. But once it's done, it's really hard to unwind.
And you want to be as close to market as you can to make it, it's already hard as it is to raise money, to build a business, et cetera. So make your deal and in your term sheet as close to market. Take one thing off the table to kind of create friction.
So Corinne, let's talk about cost management at the early stages. So you have said that one day engineering managers are going to manage AI engineers. That's where coding is really one of the best places for AI right now, and that's where it's all going. So do startups need to start thinking about that now? Should they be hiring less engineers to manage their costs better and looking towards AI, or is that just a giant pie-in-the-sky future thing?
I would say, to answer the question on engineering specifically, I would say it's not pie in the sky, it's in the near future, but it's not today. I would say, actually did a poll of this in our portfolio recently. A very large number of our portfolio companies allowed coding assistance during engineering interviews. That's not a problem in our perspective. You're replicating what the work is going to be like in the job. I would say at no point at the seed stage, between the seed and the Series A, should you be thinking about cost management to the detailed level of, I'm going to use AI in order to replace this person. Because at the seed, what you're doing is you're building the foundations of the company, right? And so if you're making major engineering trade-offs at that stage, it's probably not the right decision. Those are decisions that you can make in the future, in my opinion. So it's not something that one should be thinking about the earliest stages. 100% as one is growing, and you're thinking a little bit more about efficiency, both of the team, of the tools you're using, et cetera. I highly encourage our portfolio companies to look at every available AI tool to be able to do that. But at the seed stage, I would say use the funding that you are given to build the foundations of the company correctly, so that when you do raise a Series A and you have more fuel to put on the fire, you can build that company up.
I can definitely understand that. At the same time, I think one of the major challenges of the early stages, you don't quite know exactly what problem you're solving and quite exactly what the ICP is and quite exactly what they need. So you're going to end up throwing out a lot of work. So the faster you can go and the faster you can iterate, the better, in order to learn quickly. And so if it does mean, well, we need to kind of hack this thing together and it's not really that robust and you're going to have to refactor everything later, I would actually be a proponent of that if it means you can learn that much faster.
So I'd say if it's about discovering product market fit or testing out, you should use that leverage, but I wouldn't worry about optimizing at the seed stage or at the A.
Yeah.
Interesting. I want to point out that we are going to have a few minutes left over for questions. So about 5 or 6 minutes, I'll cue people up who have questions to come stand at the mics and let us know that you're ready to ask the questions. So Renata, what's the typical percentage that VCs take in a Series A versus other stages of fundraising?
Yeah, I mean, typical is such a non-applicable word, but like I said, kind of baselining, selling about 20 to 25% of your company at the Series A, and that as you get later, that percentage drops. But then to what Elizabeth said, different VCs have different models. So what each VC is searching for in terms of ownership, and there's probably a correlation between fund size and ownership requirements. So the larger the fund, the more likely that they're going to go to that 20% marker, because you really need every investment you make, how can you see that investment returning the fund? And if you're managing billion plus, you need to keep that ownership, and the more you come in with the bigger ownership to kind of get diluted over time and to have that investment really give you the returns. A smaller fund, so for example, at Renegade, we actually are not ownership focused. Our second fund is 128, and we actually think cash on cash, meaning how can this investment return the fund? So we have some companies in our portfolio that we have double-digit percentage ownership, that we led the Series A, they're on the board, and we have some that we have, call it, mid-single digits, and the math works for us just fine, and it's more about how can we say yes to partnering with great companies rather than say, I need to own 20% or 15 or whatever.
So in addition to things like the stock price and the valuation, what are the terms that every founder should come ready to negotiate with a VC?
Well, so I think one thing I noticed, because we invest in pre-seed companies, so super early, and at that stage and all throughout the seed, it's very common for people to be raising money on safes and convertible notes these days. And one thing that throws founders for a loop is when you get to the Series A, you're raising a priced round, and for the first time, it's not just about the valuation, it's about all the other things, and you're redlining and going back and forth with the VC, and that process can take a month. So some of the things that people often negotiate are the board composition. Who is on the board? How many people are on the board? Do you and your co-founder get to be on the board? Who gets to pick the neutral third party? Things like that. Like, that's a conversation. Other things more recently that I've seen that in a bull market is less of an issue is liquidation preferences sometimes, meaning how much of a multiple does the VC get before everyone else gets paid? And that can vary depending on how good or bad the market is. In good markets, there generally is 1x liquidation on that. So these extra terms beyond valuation actually can affect your company a lot. Like, for example, the board, like, they could fire you and you're done with your companies, right? So these things matter a lot more. And so when you get to a price round, it actually takes longer to paper than a safe. And that's something I would plan for as part of your fundraising, and make sure you have people around you who can help advise you. Could be other founders who have gone through it, or your existing investors, on what do these terms mean? Should I negotiate on these things? What am I willing to give and take on?
Corinne, what advice should you give to early founders about how much stock incentives that they should be giving to their early employees, how they should set things up so that they...
Yeah, I was going to say one other answer to that is in terms of what you're negotiating, or what prices you're coming to terms with VCs. It's the valuation, it's how much you're raising, but then it's also to some degree the option pool. And the option pool, I believe, is very important, right? And it goes back to this now question of how much are you paying your employees? Our belief is that early employees should be highly incentivized to make this company work and to stay with the company for the long term, right? The early employees are some of the most important people that the company is ever going to hire. And so, I would say, listen, there's existing benchmarks out there based on how much you've raised, based on what your valuation is, and one should go look at those benchmarks and understand them. I would also say the advice that I give our companies is you should also know the worth of your own company, right? You look at benchmarks if you want to build an average company. You look at the best companies if you want to build the best company. And so, I think, like Elizabeth was saying, I would also, take advice from founder friends, people who are 1 or 2 steps ahead of you. But our perspective is at the early stage, founding engineers, founding team members, you are going to want to compensate them well. And what we've seen historically is the companies where that happens, they stay for a very long time, and they end up being core fabric of the company DNA, and it really makes the team.
Okay, we're getting ready to take your questions. So if you have a question, please line up. And there's a mic on this aisle, and there's a mic in that aisle.
Awesome.
I think if we get a lot of people to
That's
line
great.
up. While we're doing this, the question I'm dying to ask you guys is, tell me about pitching. Is there anything during a pitch that gives you like an instant ick? Like you're going to be, no, right away. Just from the pitching.
How much time do you have? Well, so I think one thing that is using deck, not using deck, very few founders can pull off a completely unstructured conversation in a good way. People will give you the option, no use, no use. In my experience, very few people can actually effectively pitch without going through a deck, or at least having something to build upon. The other one is like the ick is when you kind of get the sense of, oh, I wanted to build something. So I was looking for something to build, and I just kind of found this, so I'm building this. So this idea of like a purpose-built founder for the problem you're solving is something so important. This idea of, oh, I wanted to build, and here it is. If you kind of glean that, we walk away immediately. When a product feels like vaporware, when you say you have something in terms of revenue, but then you kind of go in and you understand it's like a contract, a long-term contract that may or may not pay, and then you actually start doubting the things that are said to you. So those are some from me. I'll leave space for the rest of the panel.
No, this is like an hour-long conversation.
Yes, exactly.
I think those are some good ones.
Sir, this is
I-
your chance.
yeah.
to let 'em know.
This is our chance, all right?
I mean, overall, the job of the founder in a pitch is, and I think it is actually very similar to when you're selling, right, an enterprise contract. You have the champion in front of you, and your job is to weaponize the champion to make everyone around them also love you, right? And so having a deck, having well-prepared materials, it doesn't need to be a very complex data room, but having some way to both allow the person you're talking to understand your company and also weaponize them to tell their partnership about how amazing your company is, that is what leads to a very quick and successful
Oh, you're
round.
the weapon. You want to turn the
Yes.
VC listening to the
Yes.
pitch into the weapon so they can go into battle during the boardroom.
yes.
Got it. Okay.
Oh, and one more. If your pitch sounds like a late night infomercial, but wait, there's more. My partner will do this, but wait, there's more, there's more, there's more. And then all of a sudden you're a $1 trillion company. Believe me, I've seen those and it just doesn't work either.
There's a fine line between selling the dream and being grounded in reality.
That's
I
right.
think, and that's a hard line to walk.
All right. Our first question.
Good morning. My name is Mike Novielli, and thank you for your time today. Segueing from what you had, the last topic was about incentivizing your employees with equity. At what point can founders recapture some of the dilution that they experience through various rounds of financing, and possibly through employment contracts, hitting performance milestones, et cetera?
This is a tricky conversation. So one is you want to make sure that everyone in your team is properly incentivized, both from a cash and equity standpoint, and also that everyone has enough skin in the game to perform. There are moments that it's okay to recap a founder, but that's usually a little bit later. The milestone thing is probably more common in biotech. I don't see that very often in my day-to-day in terms of like, okay, founder hits his milestone, especially at the Series A. I don't see that. But then the conversation is, how much is enough to keep you happy and make the dilution work? It's never an easy conversation to have. The concept exists. Usually happens at Series C, D, a little bit later if the founder got very diluted. But it's, figuring out the price and the terms is not it's not as simple as it sounds.
Okay, thank you.
Well, and I think as just a broader point, when you think about I was just listening to this episode of The Acquired about Microsoft, and Bill Gates had about half of the company when it went public. And there are a couple of other founders who are kind of in that boat, like NerdWallet, et cetera. But when you think about that, like the way you get there is by actually just not raising that much money. And so I think this is the thing that I would keep in mind. Like before VC became a thing, how did companies make it? And it was by being very mindful of unit economics, really being scrappy with every dollar, all of the business fundamentals before everybody got caught up in fundraising. So I would not think about fundraising as like the first thing you should do with your company. I would think about actually probably the opposite. How can you make this business work? What do you need to make it work? And think about it from that lens before thinking about the fundraise.
Yeah, because you're selling equity. You're getting diluted to get capital to allow you to go further than you would on your own, or to unlock something that you can't on your own. So you're actually selling a piece of your company. It's not free money. And then to the founder piece too, like in 2021, we saw a lot of founder secondaries. And sometimes we saw them at, pretty meaningful levels where the founder was like, okay, I essentially cashed out. And the alignment between that founder and the rest of the employees, the rest of the cap table, there are a lot of things that kind of come into it. Founder secondaries can be super useful to de-risk the founder a little bit to continue to go the distance, right? A house or pay student loans or stuff like that. But if it feels like a liquidity event too soon, the incentives get misaligned and a lot of problems come out of there.
Mm-hmm.
Good morning. Thank you so much for taking the time today. It was such an amazing panel. My name is Ashwin Joshi. I'm a freshman at Berkeley. My company's raised 100K pre-seed. I'm the youngest founder to get admitted to the STEP Incubator program at Berkeley. And with all this traction, and my co-founder, who's 45, being full-time, I'm considering like a leave of absence. So you all have such a distinguished history in this field. So I was wondering what questions would you urge me to consider when making a huge decision like this?
I don't want your parents calling me. But I would, you know,
Hypothetically.
hypothetically, I would, you know, these days universities are a lot more accepting about these things, especially around here. So I would look into how easy it is to take a leave of absence, come back, like what your different options are before even, you know, making a decision, because it may turn out that actually it's fairly risk-free for you to take a semester off and see how it goes. On the other hand, it may be really hard to get into certain classes or whatever if you do that. So that's probably where I would look first.
Thank you.
Yeah.
Next question.
Hi, my name is Idris. I own and operate one security firm the traditional way and one tech security company. The tech security company is a fairly new one, but for my business, I've been in it for about 4 years, and currently year to date, it's about 4.4 million in revenue. But my question is that this tech company that we started is essentially a Uber for security guards, and we're running into a problem with licensing because you have to have a license in California in order to issue security officers, but I have a license under my main company, which is the main source of revenue that is funding the development of this app. But my question is for VCs, when they're investing, it's difficult for me to give them a solidified answer as to how much we're revenuing for the tech company, because we are fully revenuing it through Aventus Security, which is my company. How would VCs sort of invest if they don't see revenue because of the licensing part of it, or would they be more understanding?
All right, so I'm trying to decode that a little bit.
I know, it's a little
So
confusing.
you have a physical security company that's revenue generating, and then you're trying to come up with a software business that's associated with that, but that the software business is not generating revenue. Is that what you said?
No, so Aventus
If you can
Security...
speak closer to the mic, actually.
So
that'd be
sorry,
great.
is that
There-
better? Okay, my bad.
Thank you.
Aventus Security, I started the company about 4 years ago, and this year to date, it revenues $4.4 million, and it's fully licensed, bonded, and insured. For the software that we developed, it is fully developed, but we are just pending licensing, which comes in about 6 months. So contracts that we go after currently are under the umbrella of Aventus Security, but once the licensing comes in, it will be under Guard Owl.
I mean, I don't know that we can answer that specific of a question to your business, but the general question is, there's some kind of hitch with revenue being
Not
accounted
revenue,
to
the hitch is that the revenue can't be portrayed under the tech company because of the licensing aspect of it. So for VCs, how would they view that? Because we are making revenue under a different company.
They will not consider it to be part of the new venture.
Okay, so you're basically stating that we would have to get newer contracts from the beginning of the contract date till essentially the end of it.
Yeah. And I think something for the general audience here is not every revenue is built the same.
Yes.
There's something called margins. And if you actually have humans providing the service, you have different type of margin profiles and also different types of valuation profiles. So service businesses get valued very differently than recurring software businesses. So even though it's your company, these are actually completely different assets that we would be underwriting completely differently. Even though it's 1 million of revenue or 4 million of revenue or whatever, not every revenue is built the same way. So services tend to go a lot less valued and also require more capital because you don't have the compounding of
Yeah,
software.
it's a little bit more
I
expensive.
think abstracting away from the specific example, what we're looking for when VCs are looking at a new investment, seed or Series A, we're looking for a piece of technology that can be a wedge into a broader product in a broader market that is better or can replace what has existed before. And when we make an investment, it's because we believe that wedge can lead into a large-scaled company, right? And so abstract away from the technicalities of the licensing and the company structure, I would say the core thing that we're looking for is what is the technology that is being built, and we believe that that is strong technology compared to what's been built before.
So you're valuing the technology.
I'm sorry,
more
we're
than
going to
Let's
move on
save
to our
room
next
for-
question.
Okay.
Thank you.
Thank you.
Hello,
Next question.
ladies. Just a quick question. So what are the new averages for raises for pre-seed through Series A? And compare that to how much percentage founders are giving up. And what exactly has been the holdback from 2021 to compared to today as to why VCs are not investing as much?
I think this goes back to my earlier point about how markets change because of the funding stack. So VCs have also struggled to raise money, and the next stack up, they have also struggled to raise money, all the way to, the general cause I would pinpoint is around interest rates, people diverting their money into other asset classes that generate, high levels of interest. You just put your money in a savings account and you get a fair bit of interest. So that I would pinpoint as the thing, along with, a bunch of people failing in the asset class and getting scared away.
Well, and the lack of liquidity, because the
Yes.
people that give us money, they're not seeing any money.
Yes, the
back to
exits
them,
are gone, so there's no money coming back into the system as well.
And I would say even in addition to that, 2021, we saw public companies trading at 50, even 80 times software revenue multiples. And I think nowadays it's returned back to closer to what the historical average has been, which is closer to 7 to 10 to 15. And when you see a compression of multiples like that, it's very challenging to underwrite an early stage investment at a multiple that's not going to grow into where the public is trading, right? At the same time, I would say, to answer the first part of your question on where our average is, the reality is the best companies are still pricing at very high valuations, right?
Yeah, but what are those amounts exactly?
I mean, we see Series A is pricing between 80 and 100 post,
Yeah.
right? You saw that in 21 as well. So we're still seeing very high prices. I would say in 21 you saw a higher N, meaning more companies were pricing in that range. I think now it's a smaller number of pricing companies in that range, but we still see it all the time. Now you could take a perspective that that's crazy, right, compared to what you've historically seen in tech. Another perspective is like the power law is still true. And so if you love something at 60, you'd really have to put yourself to not love it at 80 too. And that's a challenging thing to say, right? And it all goes back to fund size, but it really just depends on what outcomes you're playing for. So if you're playing for an intermediate outcome, the difference between a 60 post and an 80 post does matter. But if you're playing for a much larger outcome and you're saying, hey, listen, if it sells for 200, it doesn't make a difference to me. That's a different game that you're playing, and it changes completely based on the fund size and what areas the funds are focused on.
So I'm sorry, are the big...
No, I'm sorry. We're going to have to move on. We've only got time for a couple more questions. Thank you.
One last general point on this. I think everyone always wants to know, what is my valuation, right? And that's the hard question to ask. So what I would throw back at everyone is, I would test the market. I would go to a VC, they ask you what valuation you're looking for, you say, you know more, you've seen more than I have, what do you think? And do that with a whole bunch of people, and you'll start to get some sort of range, and you can kind of triangulate. So that's how I would do it, because everybody's going to be totally different depending on geography, your idea, how trendy you are, your traction, your team, whatever.
Yeah, venture is not value investing, but price is also important, right? It's not like, whatever, it doesn't matter because it does, but it's not like private equity that, a 10% price difference can actually ruin your investment. Venture is not a value investing asset class.
Okay, we have time for one, maybe two more questions. So.
Hi, how are you? So my name is Sergey Yudovsky, company Electronic. I think Corinne, we spoke with you. Yeah, hi. So we passed that 2021, great time, raised decent Series A, played game, go big or go die. We didn't die. We made it profitable right now. We fixed almost all problems. But for the last 2 years, we had big, issues with the layoffs, churn and everything. So right now, even the company is stronger. We have a growth. We have our new products on AI. It's almost impossible for me to raise Series A because when you pitch, it always goes, okay, let's check what will be in the last 2 years.
I'm sorry, is there a question?
Yeah, my question, do you have any, couple of decent practical advice how to overcome those challenges, you understand? Because of course we can pack our company new one and just, say, okay, it's new company, new cap table, forget about the last history, but maybe we can save this company instead of, making this one? So do you understand my question, I think, right? It's pretty general question.
Yes, so the question that you're saying is basically you raise in 21, you raise a Series A, you now have a cap table that looks a certain way.
Cap table, valuation, and expectation of our new investors, because when you go, okay, Series B, technically, they expect, okay, the last 5 years, it could be a good levels of growth, but we have, like a cardiogram of.
I mean, I've seen a situation like that very recently where the insiders actually said, we're in, the founder said, okay, we're doing a recap because we want to start over with this new business, and this is how this new business is working. I have really good metrics, and think of, look at these metrics and where I'm going to take this company forward. So acknowledging the past, but don't spend a lot of time there. But they had really like a year of really fantastic metrics on this new business. They're like, okay, this is the time, this is how it's working, this is pipeline for this new business, and by the way, we're recapping to this. It's going to be super clean, and my insiders are giving me money as well. So they basically fix the problem.
All right, I think we can sneak in one more question.
Yes.
It's really fast.
I just want to say, Elizabeth, I'm a big fan of Hustle Fan. My name is Ray, founder and CEO of Regimen. It's the best toolkit for mentors to help anyone grow.
I mean,
I had a curious question on safes between Series A and B. When do you see it, and when's the optimal time to, go through a safe between Series A and Series B?
If you want to get quickly money without having to talk about price on your company, that's when you do it. You don't do it too far ahead of a fundraise, because at some point it needs to convert, and you don't want to have that pressure to convert the safe, but when you don't have the next round. And I wouldn't do it to replace a Series B fundraise, because there's also dilution. If it's some, like a quick add-on from someone you don't want to discuss valuation at this point, but you're going to come in not too long, let's say 12 months or so, not longer than that, because otherwise the conversion will kick in on you and you're going to have problems kind of figuring out how do I handle this.
And what's quick? Like, you need to raise 3 months?
No.
Less than 12 months.
Okay. We are out of time. Thank you so much for your questions. I do want to say, check the schedule. The Builder Stage actually has more VCs coming on, talking about raising after a down round or difficulties. So I think we're going to have most of your questions answered later in the day. So come back and check those sessions out. And thank you so much, my panelists.
Thank you,
Thank
everyone.
you.